Investment performance often dominates conversations about hedge funds and asset managers. But for institutional investors, returns are only one part of the equation. The real question is not just how much a manager has delivered, but how those returns were achieved and whether they can be repeated through different market environments. This conversation is for investors and allocators and anyone interested in understanding what makes a strong investment manager stand out. I'm Sahhar Saleh, and this is Insights Over Coffee.
So when we speak with investors and potential investors, the discussion is often focused on generating alpha. Yet we have learned that long-term success depends on more than investment performance. Trust, culture, risk management, infrastructure, operational excellence, and investor relationships are also part of the decision-making process. Performance may get a manager in the door, but institutional credibility is what keeps investors committed through market cycles.
Now, imagine you're allocating $100 million of your own money. What's the one thing you'd want to know about a hedge fund manager that isn't shown anywhere in the performance report?
Whether you're investing 5,000 or 5 million, the rationale is the same. How did the manager produce the returns? With what risk? And how repeatable is his investment process? Performance is essential. A compelling track record in terms of length, absolute and relative numbers, the ability to repeat the process to get to that track record, and its consistency in institutional infrastructure. These are all necessary. Building trust is also part of the journey. Transparency, accessibility, communication, credibility are necessary to build a relationship, even if it takes years. For example, many allocators decide whether they trust a manager before they actually decide whether they like the strategy. You can get the strategy wrong, but you cannot get the manager wrong. The good manager will do well, i.e. perform positively, preserve capital, even if the strategy in which he is active is not supported by a positive opportunity set. Inversely, a not-so-good manager will not perform even when the opportunity set is favorable for his strategy. Ideally, and more often than not, you get both right, the strategy, and they're a gentle reminder of diversification along the way, and the managers. And finally, the role of investor relationship teams should be highlighted here. During periods of drawdowns, of crisis, and it is where long-term partnership and relationships are tested. Again, we refer to building confidence in that relationship based on transparency, communication, and managing expectations.
When a fund is down 15% and investors are nervous, what matters more, the portfolio manager's investment skill or their ability to communicate?
It is actually both. When an investor conducts a comprehensive due diligence before investing, he is confident that 1, the manager will do what it takes to adjust his portfolio under different opportunity sets, and 2, will clearly communicate what's going on. Another topic of importance is related to risk management, also known as the invisible alpha. The operational setup is equally important as the assessment of the investment side. It really represents the backbone of how the alpha generation engine is sustained, managed, and replicated. It often goes unnoticed because its success is measured by the crisis they help to avoid.
If I offered an investor 2 funds, one that returns 20% per year with brutal drawdowns, and another that returns 12% per year with almost no major losses, which fund do you think creates more wealth over 20 years, and why do investors often choose the wrong one?
Well, the portfolio context is the starting point. The objective is to construct a resilient portfolio capable of meeting long-term obligations and expectations. Absolute versus risk-adjusted returns, drawdowns, diversification, consistency are all part of the framework. Specifically, on each manager's contribution to the portfolio, one generating 12% with limited drawdowns may be more valuable than one generating 20% with significant volatility because it improves overall portfolio behavior. Actually, we believe that investors appreciate the mathematics or magic of compounding, which is best illustrated by a compelling and often quoted statistic. A 20% loss requires a 25% gain to recover. A 50% loss requires a 100% gain just to break even, etc. In other words, managers that generate steadier returns with lower volatility and smaller drawdowns can benefit from the power of compounding. Now, because investors panic, and sometimes rightly so, during large losses, unfortunately, they tend to redeem near the bottom or re-enter after recovery. This is behavioral finance. And let's recall Dennis Gartman's rule number 4, which is the objective is not to buy low and sell high, but to buy high and sell higher. We can never know what price is low, nor can we know what price is high. And he goes on saying, always remember that sugar once fell from $1.25 per pound to 2 cents per pound and seemed cheap many times along the way. So to go back to your question, the irony is that many people think they want 20% returns until they experience a 60% drawdown or a drawdown. Then they discover they actually needed the 12% strategy all along.
How macro has changed investor conversations?
Well, the world has shifted from an era of abundant liquidity, near zero rates, to one characterized by inflation uncertainty, geopolitical risks, and higher market volatility. And thus, there's an increased focus on downside protection and growing interest in uncorrelated return streams that perform across multiple regimes, as well as greater scrutiny of leverage and liquidity. So in such an environment, the ability to actively manage risk and preserve capital is as important as the ability to generate returns. Typically, multi-strategy relative value strategies are gaining attention in that context. The environment requires flexibility and diversification, uncorrelated and diversified sources of return and risk, of alpha offered by hedge fund managers with their expanded toolkit, and again, notably multi-strategy and fixed income relative value and arbitrage managers. We will leave you with a question to reflect on. Are you willing to sacrifice some upside participation to traditional markets in exchange for smoother compounding?
And that's a wrap for today's episode of Insights Over Coffee. Thank you, Celine. I hope this conversation gave you a clearer perspective on what institutional investors value beyond performance and why trust, risk management, operational excellence, and clear communication are essential to long-term success. If you enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone interested in understanding the principles behind successful investing and asset management. We'll be back soon with more conversations on the strategies, dynamics, and ideas shaping the future of investing. Thanks for tuning in, and until next time.